Good morning. Let's get ready to go. Okay, let's see, market's opening nice and rational. Some people in here. Okay, market's opening in 1 minute. All right, let's go. Market's running open here. We are opening inside the rational band. Market's looking really good. I picked out all of my options for another month over the last week or so. Let me get everything back up front center, you guys. Good morning. Let's look at Rocket Scooter. Let's see what we got. Good morning. Hit that like button if you guys can. Grab that free trial of Rocket Scooter. Get your day started right. Windows had to load Windows 11 on its own on my computer because Windows loves to do this at the perfect moment every day. I'm still on my laptop. I'm going out of town in about 1+ hour or so. I will be driving. Let's go ahead and take a look at the liquidity map out the door. We're looking good. Markets are rational. You guys ready for the pre-market check? Smash that like button really quick. You guys got to do it. You got to join that like button. Okay, ready? Rational. Market's good. Let's double check that one. Good. VIX hasn't traveled too far. Good. NX Catalyst. That's great. Let's pull up the news and see if there's anything today of alarm. We are looking at pre-Fed stuff. Filters. Clear all. I swear I always do this. Maybe I'm just not logged in. That's probably why. Let's look at this week. See how quickly you can go through all the news. See what's going on. We got yesterday. This morning is today, I believe, is a Wednesday. The 7th is Wednesday. Let's go up here. Nothing today. Tomorrow, these are going to be very important. The initial jobless claims expecting at 2:30. That's going to be interesting to see if there's an increase in jobless claims. The less likely that the Fed will do anything crazy. We're going to go through next week and show you where that's going to be. FOMC, this is all that people are going to care about. Tuesday of next week. Wednesday of next week. This is always on Wednesday. All right, so we are pre-Fed. I like the way the market's consolidating, moving lower. Let's pull Rocket Scooter and get some plays. We have nothing really of alarm today to look at. No index catalyst. Let's double check UVXY. It's a bear short up on SPY. So how that works is BRSU, and make sure you grab the rocketscooter.com free trial. You can check this out on your own. BRSU is a trade between the hedge pressure and monthly hedge pressure. So we're looking at these two right here. You're on the bear side of positioning again, but you do have that press up from here with resilience positive. That's great. We're going to 395. This is a long out the door. These are looking super hot. Let's double check the Qs and then double check VIX just to see if there's any reactability there. With the S&P going to fill its gap, QQQ is going to 282 this morning, so that's a long side trade to there. I like that. I'm going to take any of these. Hopefully I can get a monthly hedge pressure bounce. Be very careful on the, and let's let you guys know, nothing I say or do is investment or trading advice. You should always do your own homework, do your own stuff. Don't follow anything I do. DSU, that's great. Be very careful with the 750 tap or the 775 break. Again, UVXY is inside of a very dangerous spot. Watch that monthly hedge break for that bounce between there. If UVXY does move from here and go to there, I'd be very inclined to buy the dips on the S&P as we hit hedge pressure and go. But knowing that your pivot from the downside is from here to here. So if VIX hits this area, long side trades are down. If VIX hits there, short side trades are out. If you break through here, it's a short breakout. If you break through here, it's a long breakout. So that's it. Just all eyes on UVXY today. So keep your eyes on that. Good morning, everybody. If you are here in chat right now, say hello and also click like on the stream. In about 1 minute, if I don't see 50 likes, I'm going to go back to bed and sleep. For I've got to drive a U-Haul truck halfway across the country. Long story on that, but that is part of my week-long vacation. Make sure you grab the Rocket Scooter free trial before I say halfway across the country. Halfway across the state, let's just say. About a 5-hour drive in a car. The U-Haul might take a little longer. Good morning. Sounds like I'm going on tour, right? Me and the band, we're going to our first gig. Actually, I'm moving Nicole's sister's furniture. But we are going to a baby shower this weekend, so we're like doubling up on our efforts. Okay, let's find some plays today. Let's look for bull sides again. It's actually, since we're short up, let's go ahead and do all the SUs. All I'm going to do is I'm going to match the S&P right here, SU, SU, and SU, which again, SPY. Just letting you guys know, we are officially going to be working and sponsoring a very, I say, big. We're going to be working with 2 very big names in finance as of next week when we get back. You will see Rocket Scooter's name everywhere. When it comes to like social media and stuff, we will be doing a lot of new things. My show will no longer just be me streaming. It will be a very big production, and we'll have a lot of people showing up on the show and things like that. It'll be the biggest thing we've ever done, and probably the biggest thing out there. And you guys are first in the community before we were doing all this. So if y'all remember, y'all knew me when it was just little old me. Okay, BRSU is a bear side of positions, but it's got that short side of hedging, but you're still above monthly. Those are still that downward pressure move like so. But keep in mind, any hedge pressure break becomes a bear long up, and bear long ups are very violent to the upside. So because S&P is challenging, let's immediately switch gears to do breakups. So right here, watch. First and foremost, let's find stocks that are doing the same thing, HP breakup, and get something on the list. And you can see anything that's right on the edge are things that have moved. ConocoPhillips, Intel, HIGU, Intuit, IBM, etc. So keep an eye on breakouts on your watch lists today. I would be looking at ConocoPhillips. We have the EIA number coming out in about an hour, so watch for oil prices to affect that, of course. IBM's coming out. IBM's coming out with nothing. IBM is breaking out of hedge pressure. That's a better thing to say. It'd be cool if IBM came out with something new, like it was the 80s or something. IBM invents a new MP3 player. 20 years too late. Okay. That's my phone ringing. Oh, hold on 1 second. Hello? Yeah. Sorry about that. I had a phone call. I went to the doctor yesterday to get a yearly physical. I had some health scares recently, so I had to go check up on some things. Whew, okay. Good morning, guys. What are y'all all trading today? Everybody type in a ticker. Let's do a chart on it. Do something new this morning. The new format of the show is going to start on Monday. Whew, I'm out of breath. I ran down the stairs and up the stairs. You guys have no idea. As much as I love having a 4-story house, because it's in the city, prime location, it looks really nice. I fucking hate it. I can't wait to get myself an old-fashioned, mid-century modern, 1-story house with no stairs. I'm getting fucking old. I swear. I mean, I'm 41. I'm jumping up and down the stairs. I mean, I work out a lot, but still. I go downstairs, get a Celsius. I come upstairs like breaking a sweat. BBY. Okay. As you crack one. As I crack a monster, Brooke Sabbath. Listen, you, what are you, a fucking narc? Nobody asks for your opinion. My doctor calls me and they were like, yeah, they were literally were like, I had like some, and I like, seriously, that's my favorite thing to say to Nicole. Like we go to, we go to this thing called Solid Core. Sometimes it's like Pilates on crack. And like every time you go, there's like a dish full of mints, like free, whatever they are, like Lifesavers mint candies. And I always grab like 10 of them and shove them in my pocket. And it was like our first week dating. Anytime you go to a place that gives free candy at the end, I like little candies, right? So I always like grab a small handful and keep them in my car so I can have little like candies when I drive. Just in case I get like a low blood sugar, or in case, I don't know, my girlfriend gets hangry, so I can throw her some candy and like just eat this real quick. And then she looks at me weird, like I just met this guy and he like we went on a date and he like shoved both his pockets full of mints after dinner. Like looking at me like I'm weird, and I'll look at her like in front of everybody and go, "What are you, a narc? Don't tell on me." And everyone in the restaurant, including like the managers, were like laughing and like, "No, the mints are free." I was like, "That's right." And she goes, "No, I thought it was funny because I love free stuff too." I was like, "There you go." So that's like my saying. Like don't tattle on me. So they call me and they go, "No, your panels are good. You just have high blood pressure and high cholesterol. Everything's okay. You're still a piece of shit, but okay, you're good. At least you're gonna be alive." And I was like, "Oh, okay, good." Just kidding. They didn't say that, but I'm not dying of anything except for old age, so that's good. All right. Like, where your one friend consistently steals toilet paper from the gym. I think everybody learned that habit during COVID, like where they were going to steal toilet paper from. And then once they realized it was so easy to do, nobody stopped them. It's like that episode of Always Sunny, right? When Charlie and Dee, they think they eat human meat for the first time. And like Frank, they basically were eating raccoon meat. They were trying to steal Frank's steaks. And they think they become cannibals because they've had the first taste of humans. Like once you taste it at one time, you're stuck. You're like addicted to it, right? Once you get the hunger. So they thought they were cannibals, but Frank just fed them raccoon meat and they had a parasite. Anyways, if you like Always Sunny, you'll know that was one of the funnier episodes. And it's like the first time you get away with something like stealing toilet paper during COVID, it's like you get the hunger for being a klepto. That's hilarious. A lot of people did. That's weird though if you're still doing it. But hey man, times was tough. You had to do what you had to do to get by. NVIDIA on the breakout long. Keep an eye out on 160, but just watch the S&P resilience today, guys. Make sure we stay above the 0 mark. So that's going to be what we're looking for. The messages held from review. I liked when they started smoking crack. Oh yeah, that's funny. That was the episode that got me hooked on the show. The very first episode I watched, somebody was like, "You got to watch this show. It's like the anti-Friends." And I was like, "What do you mean?" They were like, "You know how Friends is the show where it's like, I'll be there for you. I'll be there for you." And they go, "This is the show that the kids got together and were like, we should make a show where friends are never there for each other, like whatsoever. As a matter of fact, they hate each other and plot against each other. And that's the name of the show. I'll never be there for you. What, are you crazy?" And then they're like, "You got to watch this." And that's the first episode I watched. And I was like, okay, this is ridiculous. Okay. Remember, keep an eye out. We got FOMC a week from now. The monthly expirations also over a week from now. They're going to come on the 16th of December. Monthly hedgers are holding us through there. We do have NVIDIA is on the breakout play looking today. Let me show you guys again. Type in some of your favorite tickers, everybody, and smash that like button. While we're here, I'll run you through how to do some of these walls. Remember, picking price targets it's a really cool thing. I love now that we can minimize the scanner. Oh, that makes me so happy. Now, here's one thing I want to know. When I move the scanner down, pretty soon we're going to have it to where you can actually be able to pop out. My mouse is I'm on a laptop and my monitor screen is catty corner. So when I move down and up, my mouse appears to the left. Okay, let me get around the edge here. It's just the way my monitors are arranged. Okay, we're gonna have it pretty soon. We'll be able to pop up the windows. The save drawings has been released as well. Or the save indicators to a drawing set. We're gonna have auto save and all that's being worked on now, so it's coming out soon. So what I really want you to do, I'm gonna teach you guys something really cool when you have hedge pusher breakouts. This is a new setup that I want you guys to learn how to pick these price targets. Go to the walls, open it up. If you guys have not used the Rocket Scooter platform, we're doing a free trial. Make sure you go there. I'll do a demonstration. I'll do like 10 different charts. Okay. All right. Oh, Windows 11 deleted my snipping tool. How dare you remove something from my taskbar and try to force me to use something different? No. All right. So my laptop finally auto installed Windows 11, I presume. So I still love the snipping tool. I'm so old school. I love just like highlighting the area of the screen I want to take a picture of. I know there's like Snagit or other ones like that do the same thing. One second, I'm trying something different. Okay, we're gonna type in your favorite tickers. We're gonna do something really fun, a nice little thing. And boy, I can't wait to be back into my my hot seat downstairs where I can actually have to get up 10 minutes earlier to comb my hair and put on pants and look great for all you jokers, so I can come down and stream for y'all. Still on my laptop, it's kind of cool. It still sounds echo in here because all my furniture is pushed to the side of this big ass living room. So it's like a giant cave I'm in. If I sound echoing different, because that is why. Okay, so let's take a look at what we're seeing right here. Okay, BBI. Okay, let's do these. Okay, so just general formats. If you're gonna do like a hedge fisher breakout trade, you can do in predicting price targets. That is the thing that we do. So if I go to NVIDIA, for instance, and I go to the daily chart, I want to see where gap fills will be, for instance. So anything that's an open gap fill, it seems like we have one right here at 171.53. I can take a horizontal ray and go right here, plant that, 171 or 171.35, give or take, just to see that. They are fixing some of these bugs with the display. Also, my drawing is not saving whenever I switch time frames. I might write that down as well. And then, so you're gonna look for gap fills is one of the things. Hold on a second. One second, guys. All right, you guys ready? Let's go. So first thing you do is, let's just take a note here. We're having the save drawings feature, basically saving at the ticker level where we can do some things for you guys. All right, make sure y'all all smash that like button while you're here. Give it a hit. Okay, ready? On your mark, get set, go. First thing you do is you find gap fills. Second thing you do, yellow lines, red lines, if applicable. A downside day like this will likely have an impact red line and a run length red line somewhere for you to measure. Let's see how to just draw really quick as an estimate. Looks like I'm just going to eyeball this. There's likely something going on. And one of the things that we found out yesterday, we had a meeting about this, was how the chart is continuously trying. Maybe if I turn off auto, there's like an auto feature over here somewhere. Auto. Okay. I think the auto scale is what's making that happen. So what we found out is going on with the sluggishness is that just because we white labeled a small portion of our entire platform, like the charting feature, we just white labeled it. We developed everything else, but just to kind of skip ahead on charting, we don't want to remake charts because technical analysis is, completely garbage and like nobody really uses it in the modern day. Like all these indicators, like harmonics and like Elliott waves and like whatever this crap is and whatever this crap is. Nobody uses this stuff, right? But sometimes people do. Sine lines, time cycles, like this is like what's next, like crystals, horoscopes, coin flips, and pick a number between 1 and 10, right? So like nobody uses that junk, but people will still want to use charts. You have to load the liquidity map indicator, by the way. So the idea is that, you have all that stuff on there, but people were like, we would like to see charts because we still use our old methods, this and that. And a lot of people are starting to, basically woke themselves and stray away from the old school style of technical analysis. Be careful, resilience is dropped below zero. So everybody keep an eyeball out today on S&P. But right now people are starting to, transition. It's a really hard switch for people to go directly away from TA into something more like order flow or unusual volume, or what Rocket Scooter does, which are the more appropriate ways to trade in the modern day. Like our current competitors out there, like the really good platforms, they all are relevant. And that's the great thing. It's like all of the people that are still doing like technical analysis style algorithms, they've all become obsolete, and people are very rapidly, as post-COVID, starting to shy away from that style of trading, realizing that they've just been hopping around from provider to provider, and it's never worked, and they're just hoping it will. But all the things out there, anything that's like unusual activity, unusual order flow, tape reading, all of that stuff, that's all the modern stuff, and it's all relevant and good. Our competitors are great. That's why I like to, that's why we will be certainly sponsoring, I guess if you say, a really large podcast and featuring all the major tech providers out there that sell relevant stuff, including our competitors. Like the whole point about being relevant in the space is to show you guys the way. And it's not just like we're the only way. You buy our stuff and you're going to become a bajillionaire. It's like, here's something that's cool. Here's something else that's cool. Here's something else that I think is cool. And also, we're cool if you like us too. And so starting next week, we'll be doing we will be a multimedia show featuring a lot of guys that you may or may not know in the finance industry. So it's going to be more or less like Tasty Trade in that way. So I've been building my computer I have 2 broadcast studios going on now. And a lot of other secret plans I haven't even talked about yet. 2 different metal stocks. I don't understand. That I don't know. What do you mean? Meta metals stocks. I don't understand the question, brother. Meta is in. Maybe rephrase that. But anyways, so what we do here, when I go back to what I was telling you, is that we incorporated charting, even though we never planned on it because people asked for it. So a lot of the things we're working with is we could have spent years developing our own charts, even though within a year, you won't need to ever use a chart ever again. Charts are going to be a formality. And our whole thing is going to be like, throw out your charts. You don't need them anymore. And people are going to be like, how the hell do you trade without charts? Because everybody knows I trade without charts, right? I never use them. I look at them to see my levels, to watch price, but I never use anything on a chart. I don't use historic data, or historic trending data. I will use like my red lights and yellow lights every day. I can look at 930 forward with my supports and resistances marked up, and I'm done. So right now, what we're working on is clearing out some of the bugs that came prepackaged in the TradingView library that are not, they're not bugs, but bugs that are our platform conflicting with their platform. I guess if that makes any sense. So some of like the auto scaling things, we wrote our own auto scaling stuff. We can use things from the library, but they have also their own auto scaling. And I think that's what's causing it. And again, that's what's causing all the server slowdowns, because when I load a ticker and it's auto scaling, it looks like it's refreshing like 5 or 6 times as I'm zooming and scaling. So all those refresh requests are essentially, hitting the server, and that's what's slowing down your data. As we're finding these things, these are going to be big projects we're going to need to optimize. So that's kind of like slowing up monthly maps. That's what somebody asked me earlier. So like with NVIDIA, for instance, yellow line and red line, I'm just marking. I don't use Fibonacci's. I'm just going to kind of draw just so I can like find the midpoint. And let me see if I can save my default of this. Nobody uses this junk. Okay. Get off my chart. And let's make you gray. Oh, that's sexy. Actually, I'm going to make them light and dark. Nope. All I want is, I can be transparent. Oh, that's the line. Okay, actually, I don't care too much to figure this out. I just need the midpoint. So right here is that red line. You see where I marked? That's likely where that retracement level is. I'm just doing a quickie little, just show you how this works right here. So that's what we call the run length red line, and it looks like we ran right to it at the open, right? So that's just a trick. So when you're picking price targets on a breakout, you're gonna do two things. Number one is you're gonna do monthly walls. So you're gonna come here to the functions, you're gonna click monthly. Monthly walls, you're gonna look for any put wall resistances on any breakout, 360. I'm sorry, that's a spy. So let's go ahead and do NVIDIA for this example. And guys, type in some of your favorite tickers, let's go. What's up, Trader Tom? Good morning. So 100, 105, 110, there are nothing up here in the range that we're trading. So there are no monthly resistances on the wall side. Breakouts, you would look for red lines or impact red lines. So this is the first one. So if you start supporting 160, 150 on a second break, the next level is going to be right there at the impact, 164.5, where that impact is. Our videos on rocketsecurity.com, you can watch them now for free. Everybody go to rocketsecurity.com. You can check it out. There is a 7-day free trial. You don't need any credit card, nothing. No trickery, no bait and switch, no whatever. You just check out the platform. You can watch the videos. Our entire content suite unlocks for free for you. You literally can go there and start playing with it. If you want to keep it, you can start paying for your data feeds. A very, 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 very cheap subscription. Okay. Yellow line and red line are our next targets. And then gap fills. So we mark them all, and essentially the next target would have been, this would have been the target on the breakout. And then if there's a second breakout, you go to fill that impact right there. So that's it. So NVIDIA has nothing right now. Resilience is kind of bouncing at that 0 level. So we're going to keep an eyeball on that. Somebody said BBBY. BBBY. Let's put BBBY without the H. BBBY. But boy, oh boy. I love this. Okay, so here's one of the things I was trying to say, guys. Watch when I scroll. See how it disappears and reloads. This is why the platform is slow for everybody. Are you guys all watching this? For the last couple weeks, we've noticed a slowdown, and we've been doing some diagnostic studies on the server. This is what's causing it to happen, and they know what the bug is, and they're fixing it right now. So every time I do that, it's reloading. There's something that's causing that. And so I'm essentially calling BBBY, 7 times now in a short period of time. So all you guys scrolling at 9:30 are actually cockblocking each other. So it's something that we found that we're fixing. That should be fixed by tomorrow or the next day. So that's the first thing we're doing. Okay, next on BBBY, we are a bear short down. What you do is you put in your ticker, you pull up your liquidity map, BRSD, you'll have that resistance there. I'm looking for bear short down is all signs down, right? So if you are in this 1B, 1A area, bear short down is a resistance against blue. If you have the opening price is resistance as well, it sells off. So the opening price and blue hedge pressure are both going to be high volume resistances. What RocketSecure does is predict high volume resistance. As you see right here, the blue is hidden behind the yellow. They're both at the same spot, but as you see, you get right over here and there's a high volume resistance as you interact with that and particularly sell. There is no breakout target on this except for a 3.5 break that is support. I still don't short individual stocks, but if you short individual stocks and you're using our style of trading, the short is 3.5 down to some target. And again, it's the same type of analysis. When you're picking price targets, we have a video called Predicting Price Targets. If you guys that know, all of our stuff that are in our videos that we have are very comprehensive. We will teach you every step of trading, every step along the way. So everybody, do me a favor. Type in something right now. Oh God, when I go to the YouTube search, I love watching garbage people try to copy everything I do, including the look of my thumbnails. That's hilarious. I guess people just can't stand being small, that they got to copy us. I think people don't understand that that when you use keywords, right, or tags for YouTube, other people can see them. And it's so sad to watch very small, I'm talking very small, copycat, crap providers, scam providers out there using SEO manipulation to put other providers' name, like my tags, right, for my trading platform are like what we do. Like the tag is like trading, day trading, yada yada. Their tag is other people's names. So you can show up in search results next to them. You guys gotta be careful out there. There's some trickery, tricksters selling a lot of garbage. I'm staring at somebody's tags right now that is latching on to like 3 other traders. Isn't that sad, right? If you had good technology, you wouldn't have to sell it like that. You would just sell itself. That's how I feel. Okay. Anyways, I'm going to YouTube trying to get you guys some videos, and here I am seeing people trying to copy me. That's cute. Well, I wish I knew what it was like to be small and unimportant, I guess. Watch this one. This one's gonna blow your mind, guys. Watch this guy. This guy right here. This one. And backs. Okay, I got you, boy. Okay, this guy right here is a video I'm going to refer. It's called Predicting Price Targets. What it does is I have 5 ways in the morning. The first one is that I'm 5 ways in the morning to determine if market's rational or irrational. If market's rational, I will trade. If market's irrational, I likely won't trade. I'll give you the rational, irrational one, which is this guy right here. The first one I posted is my predicting price target. So the second one is, do I trade? Do I not trade? So the first one is where I trade to. And then liquidity map is where I put my stops and where I expect my pivot. So all 3 of those plus this together will give you a full understanding of what Rocket Scooter does. Anybody can do me a favor. Tap that like button really quick, and we're going to go through some things. Again, everybody here, type a ticker, and I'm going to answer the question. And we're going to go through and show you guys a quickie on the 1-to-1. So BBBY, and we'll do AMC as well for Jarnail. So real quick, if resilience is positive for SPY QQ, do you expect HP break? No. Resilience does not predict an HP break unless it has to break HP to go through resilience. So let me show you what that means. So an example, and if you go to our Discord, again, our Discord will have all this information here. Trading strats. Okay. Let's just post this here. So you will see that the order of things, right? This is the irrational checks, the unusual checks, and then the pivot checks. So while resilience outranks hedge pressure, as you see right here, the brokers that I use TD Ameritrade, Thinkorswim. I use Webull, and I use Trade of 8. So the pivot equations right here, resilience outranks hedge pressure. So resilience can, even if resilience is negative, it doesn't mean hedge pressure will break, but it outranks it, which means it can have higher volume. So the times resilience, there is a video we made called Resilience Can Predict Hedge Pressure Breaks. In a way, it's not every single time. An example would be this one right here. So if we're trading up in here and resilience goes negative because half gap outranks hedge pressure in that list I just showed you, then a negative resilience, what resilience predicts is the S&P filling its gap or not filling its gap, okay? So it's called the redistribution zone. And so when you do you have the close price, which is here, the open price, which is here. The redistribution zone is in between the close and open. When you're in the redistribution zone, resilience will predict, is it going to fill the gap that way or fill the gap that way? If resilience being positive and the market's rational, it's more likely to fill the gap to the upside. So this is a dip to buy if resilience is positive, which it is. If resilience is negative, then it's time to get out of the way. So right now, sitting in the middle like this, resilience is negative. It's pushing to the low side of the gap. Now, sometimes resilience will be following or just matching the index, but most of the time, resilience will lead the index. So resilience being positive out the door and positive now, this is a dip to buy. But the trade is to fill the gap. So the travel is not too far. So as we saw earlier, this particular setup, you had the gap fill as the target, and that's the high volume pivot. So let's go to the 1 minute chart where you can see that. So when resilience can predict where hedge pressure will break is that if resilience has to fill the gap and along the way, hedge pressure is in the middle. So hedge pressure being outside of the redistribution zone, it's not going to be impacted there, i.e. positive resilience didn't predict the break, as we said. But imagine that if you're trading up in here, up in here, up in here, and then resilience goes negative all of a sudden, then what happens is, right, the ticker wants to, or sorry, the price wants to go back inside the redistribution zone and likely to half gap and even resist it further. So when you're outside of the redistribution zone, resilience is negative, it wants to come back in. If you're outside the redistribution zone, resilience is positive, it wants to come back in. If you're in the zone, it wants to fill the gap one way or the other. That's the predictor that shows market makers are redistributing the imbalance from one day to the next. And if hedge pressure is in the way, they're not going to give a shit. They're going to jump from open to close, just like that. So do we all understand how gap fills work? We'll do a quickie little tutorial on this. So if you do right here, and again, everybody, if you can smash a like button, I'm about to drop some knowledge bombs. I'm going to show you guys how to predict gap fills, and y'all are going to love it. This is the best thing you'll ever learn because it's so easy. You don't even need rocket scooter to do it. You can do this on your own platform, and this is a free indication. This is a technique that we invented, by the way. Rocket Scooter is a team of engineers. Rocket Scooter is a nod to all of our engineering background. The group that started this company. We're 3 engineers, a chemical engineer, a mechanical engineer, and an audio engineer. I started this company, but started this team. And ever since then, we've been developing and creating stuff. We've invented 15 ways to predict volume, predict high volume. So volume pivots before they happen. We are faster than technical analysis. We're faster than anything. We will give you volume pivots. There's nothing like what we do. There's nobody even close to what we do. The first thing we invented, there's nothing close to what we do. And over the last 6 years, we've made enough stuff that you guys, what the heck is this? We have enough stuff to really just give you guys a whole new set of tools, okay? The boundary of the redistribution zone is what I've drawn right here. Let's go ahead and see the settings. Let me change this color to like a, let's do like a red color. And let's do, and you see how with resilience being positive, I'm saying that that was a dip to buy on SPY, and look what it did. Exactly, and I love when I'm teaching something, it happens exactly as I'm teaching it. So you guys can see it live, which means you can rewind this video tomorrow and see when Matt goes, that is not a sell-off, that is a signal to buy, right? Just as a demonstration. Again, this is not trading advice. Don't buy or sell off of what I'm saying. I'd like to give that disclaimer. Even though y'all aren't paying me in this stream to give you the advice, I still make sure that you understand I'm not trying to direct your trades. I actually take a large stance against that. I think that it's more appropriate for me to say that all of y'all are trading against me, so may the best man win. Good luck to you. Daddy takes care of number 1, but I also like to teach you guys as well. So redistribution zone is in between the open and close of yesterday. Do we all see that? So when I say it's a signal to buy, let's just assume this is historic just to teach. Everyone type a big fat yes in chat if you get what I'm doing. The gap fill you measure from the closing print, or the closing bar, and let's get this right on the money here. Okay, everybody that's present, type yes in chat. How many people are listening to what I'm saying and want to know a quickie little lesson here? Okay. It's your first day in Rocket Scooter, you're like, I'd like a lesson. And see, when I refresh the chart, it doesn't stay. That's what I need to get them to fix as well. Okay. So we need. I'm taking notes while I'm trading as well to show my guys as I'm going out of town what they need to work on. So where I just drew, and again, like I said, I'm gonna redraw this right here and right here. Okay. One of these days, when we have a big gap and nothing else to make, we're gonna make our own charts. That way, we can not have to do the we can make them optimal, and we're not going to fluff them up with crap people don't need. Okay, does everybody remember earlier today when this happened, I go, that's a buy signal. Remember that high volume, right? Does everybody remember when I said this, that this was a buy signal? Does everybody understand why? And if it's your first day here, be sure to grab Rocket Scooter at rocketscooter.com. And when you go there, you'll be able to check out the platform as well, okay? No. So it was on the 5-minute chart earlier. This fell to the open, and at this moment in time, resilience was positive, and we're at the lower end of the redistribution zone. I hate there's a delay on YouTube, so I don't know what you guys are saying no to. When you're inside the redistribution zone, which is between the open and close, we all understand that so far? I'm not going to move too far to the left to show it. This is the open price. This is the close price. Okay, let's put a little text note here. Open. Oh God, you guys are saying yes again to something. I just need to here, close. Okay, so redistribution zone is the period between the open and close of yesterday and today. Okay, all right. Inside the redistribution zone, resilience at any moment in time will predict which way you go. If the market's rational. So rational means everything just makes sense and is pretty. Let me use some colored rectangles just to kind of demonstrate. At this moment in time, you're inside the redistribution zone. Resilience is positive. Okay, so right here, signal 1, resilience is positive. It goes to fill the gap. You're back inside the redistribution zone. Resilience is positive. I wouldn't short this because resilience is positive. Okay. Resilience being positive means inside of the redistribution zone, it's this. Okay. It is just like that. Hold on one. So let me see if I can draw arrows. Like just not geometric shapes. Let me see if I have like drawings. I can just draw like here's emojis and stuff. Okay. So the way that it works is when resilience is positive, oh, these are so goofy looking. I love it though. Resilience is negative. Okay. So the way that it works is res positive. What resilience is arbitrage, and it's an exploit of the S&P tracking what the stocks are doing, and it's an exploit of one particular thing. Hold on one second. All right, guys, I'm back. Sorry about that. So when I told y'all this morning that we're moving a U-Haul, so Nicole's sister having a baby shower this weekend. So we have a U-Haul full of stuff for them. So they're having a baby. We're actually driving a bunch of their furniture from Houston to Dallas today in like an hour or two. We're going to be leaving. And also stuff from the baby shower. So like Nicole planned this whole thing. It's all zoo and safari themed with animals and stuff. We got all the shipments sitting here. And we were trying to we had a friend bring over a U-Haul. So we're trying to get everything all packed up and put into this U-Haul this morning so that we can drive out there. We are making a little bit of noise, so I just muted the mic while everybody was here getting all the stuff. So she's in the process of getting everything together. We're getting also our bags packed. So sorry about all of that. Okay, back to the lesson. Okay, let's get everybody back. Sorry about taking so long. Okay, if you are here, big old fat yes in chat. Let's hear it. Let's go. We're back. Okay, let me go ahead one more post. Okay, let's go. Okay. All right. So far so good. We all understand redistribution zone. Okay, let's pull this really quick. So first and foremost, you guys know how liquidity map works. In liquidity map, you have where our indicators will show you where volume pivots will be. Predictable volume is very easily seen through Rocket Scooter. Anytime that you interact with hedge pressure or half gap, you will see volume interactions. So volume spikes at this half gap relative to like wherever you are on the liquidity map. And of course, the intensity of the second and third tap should be less. But anytime you see these volume spikes, they're not random. They are interactability with these particular pivots. And there's a reason why those pivots create high volume. And that's what we were come to know to create here. So appreciate you guys being patient for me. And so sorry for the delay there. It was kind of funny because y'all know me. I don't wear pants whenever I'm streaming. I have to wear pants. I'm such a like hippie. I'm literally like sitting here. I'm wearing boxers or boxer briefs for sure. But like my buddy's all up here walking around, and I'm like, I'm wearing a t-shirt with Joey Ramone on it and my boxers. Because y'all know I'm like a hard rocker, punk rocker from back in the day. And my buddy's like, "Are you working?" I'm like, "Oh yeah." He's like, "Is this how you dress for work?" I go, "Oh, absolutely." That's also how I dress to sleep. So, yo, what's up? Hey, what up, New Age? Good to see you, brother. Okay. By the way, I need to chat with you. I'll probably give you a phone call today. You gave me you tweeted me your number, I think. I need to chat with you about something. I'm gonna be on the road for like 5 hours. I'm going to Dallas, so I'll hit you up. Okay. So back to resilience, okay? What resilience actually does is it is arbitrage between the S&P, the SPY, and the sum of what the stocks are doing. Now, the redistribution zone is this area that I drew right here, okay? Right, redistribution zone is this entire thing. Let's just make it big, okay? Redistribution zone is anytime the market gaps up or gaps down. Oh, wow, when I change the text size, it changes the text size here. That's interesting. So when you gap up or gap down, there's always an order imbalance, right? You always hear share imbalance to the sell side, share imbalance to the buy side. SPY, 500,000 sell imbalance, right? Those sell imbalances and buy imbalances are positions that had to be held by market makers overnight. So when you're doing any kind of delta hedging, as example, like myself when I trade, if I long some kind of stock and I buy the stock at the end of the day, say that I'm a hedge fund and I buy 100,000 shares of Apple. But I also know that between 4:15 p.m. and 9:30 in the morning, and in the overnight, there is a 16-hour pretty much window of variability where global markets can do whatever they want, and we're the last market to open and close, right? So the way the globe spins, Australia opens, Asia opens, Europe opens, and the United States opens, and by the time we're closing, right, is everyone else's early morning. And so we're the last market. Therefore, we're sensitive to what other markets are doing. A global event like a terrorist attack or a war or something that just pops out of nowhere that we wouldn't know could stimulate some kind of move in some kind of industry, and the foreign markets will be the first to react to it. Our futures are the only thing that will have the ability to move and take an effect or account for that change. Example, Ukraine and Russia war. That time zone is when we are in our evening, right, in their mornings. So our stock market is closed, and especially our options market is closed, right? Stocks have after hours trading, yes, but options don't. So when I'm buying 100,000 shares of Apple at the end of the day as a hedge fund, right, I'm kind of sitting there naked, right? No pun intended, as I'm sitting here partially naked myself. Just kidding. Boxers on. And so, right, nobody would sit in a chair without at least boxers on. That would be really odd and gross. Okay, and going back to what I was saying is that you will know that overnight you need something to hedge just in case something happens in those 16 hours. Imagine buying an options contract to hedge. Now, imagine I bought all that stock, right? And I want to put a stop loss. Well, at midnight, my stop loss is not going to trigger. Nothing can happen. I have to wait till 4 in the morning for pre-market trading to open. But then again, I can't exactly dump 100,000 shares of a stock in after hours trading. That's going to be completely illiquid, and I'm going to get completely hosed on that fill. So I have to buy options at the end of the day, or else I'm stuck. And options are a guaranteed stop loss. Say I bought Apple at, 100, or say I bought Google at 100. And overnight a war breaks out and it falls to 90. Well, I'm completely screwed. I can't get out of that position that easily. And so say that I bought it at 100 and I bought put options for 99. And I wake up in the morning, I don't care what happens next. I have the option to close that position at 99 no matter what. Do we all understand? Yes, and click like the stream if you understand what I'm saying. We'll move forward with the next topic with that. So the fact that I buy options just to make sure no global event breaks out, and in the morning I dump those options. I don't need them anymore. I can just stop out of the trade. So normally when you think of options, think that people are renting the options for so many hours to guard over for some kind of effect. You don't need to have options all around the clock unless you just want to set it and forget it. Think of an option as a guaranteed stop loss. But remember, when you're at the money, theta is the highest. So when you're at the money, your option will decay the most, especially to volatility and chop. So every, theta prices in real time, right? So your theta is like a hole in a bucket full of water, and theta is just how much is dripping out. The closer to the money you are, time being not a factor, like for 0-day expiration, right? The closer to the money you are, the theta is going to drip out the fastest. The hole is the biggest, right? And at a particular price, the further out in time you are for expiration, the smaller the hole is as well. So the nearer term expiration and at the money is your highest theta loss. So theta is how much your options premium is going to lose in value. If you want to learn the easiest way to learn about options, now again, you may not be an options trader, but if you don't understand this, you won't be a good stock trader. Options control everything in the modern stock market. If your trading provider or algorithmic salesman or whatever does not use the word options, they do not understand the stock market at any point after 1992. Okay, literally technical analysis is stuck in the dark ages. Options are almost every bit of activity that you can see. Proof is in the pudding. These high volume spikes we can predict all are determined from effects of options, and that's it. Option, imagine what theta is a Greek. And you say, what is Greek? It's how much your options value loses in real time, or the way it's presented to you on your platform. It's for the 24-hour period, and it's an average. So if your theta says 0.15, it's saying over the course of 24 hours, your option will lose 0.15 cents per share, or 15 cents per contract, or $15 per contract. So contract represents 100 shares. Or just think of it as a rental fee. That number divided by 60 or by 24 is how much. And again, it's not going to be a linear amount every hour. It's going to scale differently, but it's a curve. But if you were just to kind of be easy about it, say if theta was 24, then it's going to lose 1 per hour, give or take. It's going to obviously be not exactly 1 per hour. It'll get faster the closer you're at expiration, or higher. But the idea is it's a rental fee. So imagine like Blockbuster Video or Hollywood, you go out there and you rent a video for 8 hours, and as a fee, and you turn it back in. So if you're hedging a position between close and open, imagine renting insurance just for a short period of time. SPY 400s? Oh, absolutely. Absolutely. Yes, boss. So does everybody understand that the rental way of thinking of options? Rental is the best way to think about it. I need to protect myself just for the overnight. There's some instability around the world, and there's rumors of something going to happen. I just need some options, to keep me overnight, because I won't be able to effectively close a massive position overnight easily, even in pre-market. So I just need, if I bought at 100, I'm going to buy puts at 99. Therefore, at any point tomorrow, I can exit at 99. Every hour I wait, it's going to cost me more to hold those options. But hey, I'm going to exit where I want when the market's open, and I can close all of them out at exactly that price. Do we all understand that concept? So when you have an imbalance or a desire to not have full risk on the table, i.e. you're scared something might happen overnight, you will buy options. So imagine your job is now called market maker. At the end of the day, everyone submits their orders. They're called market on order, market on open orders, and market on close orders. I'm going to teach you guys something. And I want you guys to go to rocketseer.com and try out a free trial, and go to our Discord and check that out as well, because you guys are going to learn so much about how the market actually works from us. And all of this is free, by the way. We do have a fee that covers your data feeds for our platform, but you can also try it for free. This is a very cool lesson today that you're going to learn. Market on open order is an order that is to be executed at the day's opening price. So what happens is the market makers are people that will control where the price is at the open and where the closing print is at the close. And what they do is they try to find the most liquid place to match all these big orders that are coming through, as well as facilitate orders that are happening in real time. You submit the order up to a certain time, and it's up till 9:28 Eastern, so 2 minutes before the market opens, and execution is guaranteed providing there's liquidity, but no guarantee what the price will be. So imagine that you're like, I want to get into 100,000 shares of a stock, and you want to go in there and start day trading it all day long. Well, okay, I mean, that might be easy to do if you have a floor of traders and you have 100 stocks you want to buy. You have 100 traders, like, hey, each one of you get into Apple, you get into Google, you're working on Facebook today. You guys all get in at the best price you can. These traders have to hustle and bustle all day long to try to sneak into 100,000 shares without the market sensing they're buying. Boy, that's going to be hard, and you're going to take a penalty, right? Because you're bombarding the market with buy orders while it's open. Instead, you can do what the easiest thing to do is submit a market on open order, which is to say, we want 100,000 shares of Apple, 100,000 shares of Google, 100,000 shares of Facebook at the open at whatever. And so whatever price the market maker gaps to, right? As a matter of fact, I do want to record this, and I'll make this a video later. So in the morning, market on open orders will be an order that somebody can submit to the exchange. And when you submit that order to the exchange, if you want a large amount of shares, instead of buying 100,000 shares of something when the market's open, you just want to buy them at the opening price, because you trust that market makers' desire is to find liquidity, which means they're going to find the place and buyers and sellers are in equilibrium, which means they're going to open at a fair price. And so if you submit a market on open order before the market opens, you can get your 100,000 shares immediately at market open at the opening price. So the redistribution zone, as I've drawn, is the open price and close price from the previous day. So imagine yesterday we closed at this level where this green line is, and we opened right here. It means over the course of yesterday and today, the market makers believed that liquidity was here where buyers and sellers would equilibrium. And if I submitted a market on open order to buy 100,000 shares of SPY, I got filled exactly here at 392.76. As a matter of fact, the reason why you have a U-shaped volume distribution over the course of a day, that high volume at the end and beginning of the day are mostly those orders. And so the benefit of doing that is, imagine trying to sneak into 100,000 shares throughout the day. You're completely revealing your hand. And also, you have to hire traders to do that. Say you want to do this for 100 different companies and you have a mutual fund. And you're going to buy all the stocks. You can tell each of your 100 traders, guys, you buy this, you buy that, you buy Apple, you buy Amazon, and they're fighting all day to sneak in 100,000 shares of each. That's a lot, and they're going to take penalties on it. They're going to get really bad fills, and they're also going to be showing the market maker that they're just flat out buying throughout the day. So clearly when the market's open, they're going to raise price to look for sellers. So you're going to get worse and worse fills as the day progresses. So the reason these market on open orders happen is so that a hedge fund or a mutual fund or whoever wants to buy a large amount, institutional traders, can get into a large position at one price without the slippage. That is a hella good benefit. It not only keeps them from getting bad fills, keeps them from revealing their hand as easily. It also keeps them from having to staff up on traders just to get in and out of positions. One person can literally buy 100,000 shares of 100 things and prep it all before the market opens and just say, fill me at the best price. And that's really what that is. Now, the problem is, think of the close of the day now. At the close of the day, there was a massive rally. Everybody bought on some news. But right at the end of the day, some new firm jumps in and shorts 1 million shares of something right at the end of the day. And that's the only closing order. Let's imagine that you can do the same thing at the end of the day. Market on close orders. You can submit an order to the dealer and say, hey, I'm going to fill this position. Give me the best price. And you submit an order, right before the cutoff is, and you tell the market maker, I'm going to enter a new sell order for 100,000. And they get all those orders. And then right at the end of the day, they also facilitate that imbalance. So imagine that you're the only trader at the end of the day and you sell 100,000 shares of something, or 1 million shares of something now. There has to be a buyer, and say that there were no buyers in the market itself. And the market maker says, well, I have to be the buyer. Okay. So they now bought to your short. We all follow? So far, so good. If you are lost, say, man, I'm lost. If you're following like a charm, say, okay, I'm following. Let me know that you're following the story and I'll continue. So imagine you're the only seller and the market maker is the only buyer. The market just rallied on good news, right? And you decided to be the only person to take profit at the end of the day. You dumped your shares. They had to buy from you as you're selling, okay? So they're long the market as you're selling, which in this favor, it's a favor to them in this point because the market just had good news. But what if in the morning, everybody had market on open orders that were to sell? So they had the lower price, right? Because at the open, something happened overnight. Everyone decided to open by selling. So now they have to gap the price down to look for buyers. And they were long on top of that. Ooh, no good. So they don't ever put themselves in that position, right? And one of the benefits of having the options market open until 4:15 while the equities market closes at 4 is for this very thing. It gives market makers 15 minutes to adjust their risk to balance and rent, quote unquote, options as we described earlier. They're going to rent options overnight just to make sure they have no risk when they wake up in the morning because they don't know what we're going to do in the morning. Okay. So at the end of the day, market closes at 4. Somebody shorted to them and they bought. And because they bought, they also went and bought equivalent amount of puts wherever they decided they want to get out of that trade at. Maybe exactly the price they bought it. Now, being a market maker, they're now balanced. And when I talked about theta earlier, theta presented to you by your trading platform is the amount at which your options premium decays in value on a 24-hour period, as it's typically presented. Theta actually decays in real time. It's priced in real time. But it's if you look at your number on your, for instance, your options ladder, at some option strike at some time, it might say theta is 0.25. It means for every share of stock, your option is going to lose 25. Alexa just said something. So for every If it's 0.25, it means for every share of stock, your options premium will lose 25 cents. Or for an options contract, it's 100 shares of stock, it'll lose $25 a day. So you can assume that you're renting that option for that day, or in the course of buying a put overnight just to hold, because you don't know what the opening print is going to be, because you know what people are going to do. Imagine like an almost 16-hour period. Let's see, what, 9, 8, like 17 hour, whatever. That period is what a market maker will need to rent some options. Essentially pay from 4 o'clock till 9:30, 17 and a half hours, right? They need to rent insurance to get a stop loss guarantee for 17 hours. So they're going to be 17 hours worth of theta to hold that overnight, which is fine because they make that money back from market making. But essentially, they're going to buy some option in the 15 minutes before the options market closes. So market gaps down, which is what we saw in the SPY. And as the market gaps down, the dealers likely had puts. So price lowered, their puts made money. Their long lost money, but they balanced it equivalently to where the overall trade was as neutral as possible, which is great. But here's the thing. They got out of those options just because they were, maybe they got out of the options, maybe they still hold them. But the point is that now they're still long the market and they dip the market lower, right? So inside of this zone is where they redistribute their long to buyers and sellers. The redistribution zone is a high amount of buyers and sellers. And how do you know this? It's because if you look at the volume distribution curve, there's always high volume at the open and high volume at the close, because the market on open and close orders are high volume. That's all your institutional longs and shorts, right? So there were a lot of sellers at the end of the day from this example, and they lowered the price and they're starting to find buyers because you lower the price to find buyers. So if there are sellers here and their calculation said that's where the buyers are going to be, then sellers and buyers create a nice liquid area called redistribution zone. It's the highest liquidity between one day and the next. And it's easy to determine because the market makers get everybody's hand delivered to them before they even open the market and before they even close the market. They get a full reveal of everyone's positions that doesn't want to be at the mercy of filling live, right? So they know what everybody wants to do. They can do a quick calc and say, well, this is the imbalance. Let's drop the price here. Let's buy our options after that or before that, whatever. So that's it. And so in the redistribution zone is a high buffer of buyers and sellers. Do we all understand that? That's why the opening price has a very high volume candle. The opening candle is a very high volume. The closing candle is very high volume. And anytime you're in between those two, buyers and sellers are in harmony. Right at the half gap, which is something we teach, the half gap is your highest volume pivot of the day. Anytime you touch it and pass through it, the volume can even be higher than the open sometimes. Look how crazy that is. Look when you bounce off of it. Look how crazy that is. Do you see that? These are market maker offloads of that imbalance overnight. You are seeing it before your very eyes. We gap down, which means the dealers were probably long against a short, a net imbalance. So you have a closing imbalance and an opening imbalance, right? The imbalance, Alexa, be quiet. I don't know what I'm saying imbalance, and she thinks I'm talking to her. She's so saucy. Anyways, you have an imbalance and another imbalance. The net of the two is the imbalance of the two imbalances. The total imbalance dictates if we gap up or down. Okay? Is that funny, right? So now you have an area where dealers are either long or short. You either gap up or gap down. And it doesn't, when you gap down, it doesn't mean the dealers are net long or net short. They can be both. They're going to gap down based on the expected liquidity of the morning. Even if they were short the market and the expected liquidity was further short, they can gap it in their direction. They can gap it against themselves. They don't care because they're balanced anyways. It's not going to affect them. So if they need, essentially their goal is if they're like a seesaw, right? They seesaw to the left and take a short, they need to spend some time bringing that seesaw back to flat. If overnight they seesaw to the right and take a long, they need to spend the rest of the morning bringing that long back to flat. So that all they're doing is getting out of the position they're in, whether it's getting out of a long or getting out of a short. And in the redistribution zone is guaranteed buyers and sellers because they've submitted those orders and told you where their risk is. A hedge fund selling 1 million shares or shorting 1 million shares here and longing 1 million shares here is not going to hold, it's not going to get out of that trade the next morning. They're likely holding that for the long haul, right? And they may even show their hand further. Yeah, I bought at 392, 1 million shares, and all of a sudden there was 10,000 options that showed up at 390 for like a month out, and they see that too, and they go, this person bought this and bought those options. So their risk is probably held for a month out, and they're going to hold this position. But they know that somebody has risk there. So essentially with everybody revealing their hand, they know where the buyers and sellers can and will be. So in this redistribution zone, say that people were longing at the end of the day, right, buying into the rally, and people were shorting in the morning, those traders are all upside down in the middle, the other side of the coin. And now you can squeeze people out of their longs and shorts by touching those edges, right? And you just know that people are hedged at each one of these boundaries because people were longing at the top and shorting at the bottom as well, because that's why that was the top and that's why that was the bottom. So you know that people will be getting out of trades on the edges of this. And you know there were buyers there and were sellers there. It's a perfect gauge of liquidity. And liquidity is the maximum squeeze point of all traders, where the buyers and sellers are in equilibrium, which means they're trading against each other, which means they're likely both losing to the house. And so buyers at the end of the day, this is a new side of this discussion, and sellers at the start of the day, which is that imbalance, are now both upside down in the middle. The longs are losing, the shorts are losing. That's where liquidity comes from, is that people now, if you're winning a trade, you're likely not to do anything. But liquidity doesn't mean you're winning a trade. It means the highest amount of orders that happen in the shortest amount of time. So it's the most amount of activity, i.e. the highest volume. So predicting volume is predicting liquidity, right? And so you can think of liquidity as that drop, again, the example of a bucket with a hole in it, the amount of drops that come out of that bucket per second, drop, 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 drop. People are more likely to not do anything if their trade's winning. Humanity, it's called the hot hand fallacy. Your trade's been going up, you assume it's still going to go up, and you tend to hold. That's why you bag hold. That's why you hold trades too long. You think that something won, it's going to keep winning. So you're less likely to do something or change something if you're winning. You're more likely to think that your winning hand is going to continue to win. However, if you're losing, you're more likely to leave something that's disadvantageous to you because of fight or flight. Humans are more likely to escape a bad situation than they are to exit a good one, which is why lottery winners always lose all their money, because they don't think anything's going wrong and they're less likely to change their behaviors. Okay, these are human things. So in the middle, everyone's upside down, so they're more likely to exit their trades, i.e. submit orders and cause order flow. So the max amount of liquidity is literally the real max pain of the market, where most people are losing their trades because they're going to be more likely to get out, which means they're going to be buying and selling from each other, not to get in the position, but to get out of the position. It's very important for this analysis. So what resilience actually does, and I'll talk about this, is the idea that you know that we'll just tell you if you guys believe that the market pivots to open and close to get out of whatever that imbalance is. And once that market maker is out of redistributing those millions or tens of thousands or hundreds of thousands of shares, then they don't need to redo that anymore. They're back to neutral. But they're also facilitating new orders, right, as well throughout the day. So, but you can see that the opening and closing price are always pivots. You futures traders and index traders, you always see when you touch the open, there's high volume. Touch the close, there's high volume. Break through the open, there's high volume. Touch the middle and move off of it and break out. Well, see, it's now, there's no longer volume anymore. When there's no longer volume that needs to be redistributed, you traders that are learning something, that's usually when the breakout happens and your minds just became blown. Let's get some applause in chat or some, wait a minute, wait. I've never heard Matt say this before. This is a new lesson for y'all. And this is a new video. Where's the volume at half gap? Where's the volume up here? This breakout is real sentiment at this point. Do we all see this? When you hit the open and volume goes up, when you hit the middle and volume goes up, when you hit the high and the low and volume goes up, and you hit the high and volume goes up, the market maker is still offloading their crap. When you hit the middle and there's no volume, and you hit the upper band and there's no volume, and the volume's in decline and there's no volume spike, they have already found neutralization. Okay? Y'all like that? Let's get a yes in chat. If that is like, oh my God, that's crazy. They've likely redistributed everything now because there's no more buyers and sellers anymore. They're looking for sellers up here maybe, and they were finding them possibly, but now they're no longer finding them. So when you don't find the sellers at the boundary, what do you do to find sellers? You continue to raise the price. So this stage, the movement is over for now. No, at this stage, the redistribution zone is no longer providing sellers. As you tap the lower band, they found buyers. As you tap the lower band, they found buyers. As you tap the lower band, they certainly found buyers. If you tap the upper band, they found sellers. You tap the upper band again, they found sellers. You tap the middle, they found nothing. Whoa, we lowered the price and there's no buyers. Ooh. We touch the upper band, ooh, there's no sellers. No more buyers, no more sellers, no more liquidity. When volume is in decline at half gap or one of the boundaries, the redistribution zone no longer provides liquidity. You now have full visibility on the market becoming illiquid again. And illiquid markets are markets that move. Your breakout starts when volume is in decline, and no longer will they find their buyers and sellers from the gauging of the previous day's open and close. So when you are at half gap and there's no volume, and if you touch the upper or lower band of the redistribution zone and there's no volume, it likely wants to get out of the redistribution zone very rapidly, one way or the other. So how can we use one of our tools to decide which way it breaks out? Everybody, if you type it in chat right now, I will be so proud. Which one of our tools would you use at that moment in time under the conditions? You touch the upper or lower band of the redistribution zone and there's no more buyers and sellers. You touch half gap and there's no more buyers and sellers. You've now determined as a market maker the markets are illiquid. And you are at half gap. Resilience. Because what resilience is showing is this same thing, this same exact balancing act across all 500 companies of the S&P, and the net sum of them being inside or outside of their redistribution zones as well. So if you are at half gap, say imagine that you are at half gap from here to here. Oops. I invented resilience, Jorg, to trade S&P futures with. This was invented for futures traders, but everybody uses it that trades any index product. So the idea is that if at the middle is the maximum squeeze point, you can find sellers there and buyers there, but at the point of no volume, you no longer can find buyers and sellers there, likely. The market's likely to move from that point in time. But the thing is that imagine that we're still back here, and you know that when you touch the upper and lower bands, there are buyers and sellers. So you know that if you're above the midpoint, imagine we're looking at Apple stock right now. Apple is looking for sellers. It's going to also fill its gap. Do we understand that? So if Apple moves just a little bit, imagine looking at Apple, and it moves just a little bit where my mouse is, okay? You know that Apple is looking for sellers because you're raising price, or price is raising. So therefore, it's going to likely fill the gap that way to find those sellers. And as long as there's volume, then that move is going to take place. So if Apple's only moved a little bit and it has a lot more to move, we call that the implied move, i.e. the move that hasn't happened yet. So the move that hasn't happened yet is very predictable because as you see above half gap, it wants to go there. So now you have step one. You can predict a small move in Apple, right? because you assume this mechanic I just taught you is what's happening in all the stocks, which is very true. The same little song and dance is happening in each stock. So if Apple's going to fill its gap, then you can say, ooh, Apple's $1 away from filling its gap. So Apple's implied move is $1. And that dollar move will add, plus, at Apple's current market cap, will add a certain value to the S&P. You can actually calculate the value of the S&P will go up based on Apple's move that hasn't happened yet. You are now forecasting a future price of the S&P that the S&P needs to be at if it's tracking all the stocks effectively on a move that hasn't happened yet and one stock that's high market cap that you can predict will likely happen. And if you do that for all 500 stocks, you now have the perfect arbitrage of balancing the imbalance between open and close of every stock in the index and finding out if the S&P is lagging or leading that move. If the S&P is completely not, like if somebody is dumping the S&P by selling SPY and SPY is trading down while them dumping that money into Apple, Amazon, whatever at the same time, then the stocks are going up. Then the stocks are going to continue to go up to find sellers while the S&P was temporarily depressed. There's an opportunity of arbitrage for you to either short the stock or long the index at that point, because the index will track the sum of the stocks weighted by market cap appropriately. And if the index is lagging behind that process in the redistribution zone, you sum up all those implied moves. Now you have the rate of implied hedging, which means if resilience is positive, it means the sum of all market cap in the S&P in the redistribution zone is above half gap. There's more market cap above half gap than below, and there's a certain value at which the S&P needs to go to balance that out, which means resilience, this white number is positive, and that is all that it means. If this white number is positive, above 0, then it means there are more stocks on the north side of their redistribution zone than there are on the south side of the redistribution, or more market cap, not just stocks. So if resilience is positive, it means the S&P's market cap needs to go higher inside of this zone. That's it. To find sellers just inside of this zone. Because the stocks are about to run really fast to find sellers, which will cause the S&P to run really fast to track those stocks when they do move. Since the move hasn't happened yet, resilience is a forward-looking indicator. And if you just get tingles on your arms to say a forward-looking indicator that shows me something before it happens, this entire coaching session very, very, very appropriately explains why that happens. None of your technical indicators can look into the future. None of them, because they look at past price data to try to make an inference on the direction of future price. We're looking at a market maker balancing practice that you've never learned about before, and now a bunch of engineers are telling you about it. And it's a very simple thing. Once you think about it, you're like, man, why haven't I thought of that before? It's like going to an art museum and seeing the white canvas on the wall and say, oh, why haven't I thought of that before? It's not that you didn't think about it before. It's just that it's such a foreign thing that you didn't know it was going to be beautiful to people until you explored it, right? You didn't know putting a white canvas up, people would resonate with that at the time. At this point in time, when you have all the information available to learn these things, it's now like an eye-opener. Like that is kind of cool, because you can say that, yeah, I do believe that at half gap, Apple, if you're above it, Apple's going to go to find its close, right, to fill the gap. So therefore, the S&P is going to incrementally go up a little bit. But what if Walmart's going down? Well, the S&P is going to go down a little bit. And when you balance all of that out, you get the perfect arbitrage between the S&P under tracking or over tracking the implied value of the index, which is the value that hasn't been achieved yet, while stocks are inside of their own zone, which is a very predictable move to touch that open and close. It's very, very, very predictable because there's buyers and sellers at each piece of that until there's not. And as long as there's buyers and sellers at each piece, resilience will know that. And resilience will take into account that the S&P needs to go up or go down. And there's a saying around here where people love to say, just for fun, is that resilience is never wrong. Just to say that's fun, because resilience actually is just showing you that stocks are looking for sellers or looking for buyers in that zone. And so the S&P tracking the stocks by saying it's never wrong, they're really saying the S&P never really doesn't track the stocks. It almost always does. Very rarely will SPY deviate from the sum of the stocks. Sometimes on earnings, maybe you'll have days where it just doesn't do well, or in a rational market, it doesn't do well. But markets are nice and rational and steady. Boy, oh boy, is resilience my favorite indicator that we have, because when it's positive and the S&P is at its inside of the zone, positive resilience, if you watch the first video, means that the S&P is likely to look for sellers, and you know it's going to go up to the top where the sellers would be. So if resilience is negative, you know that it's going to likely go to the bottom of the zone. So at this particular point in time, there was no lead. It actually just tracked. But many times, especially in bull markets, bear markets are choppy and volatile markets are volatile. And you're going to say that the resilience is just going to reflect and not have any leading power like today. It's actually lagging a little bit. And that's sometimes normal in bear markets or irrational markets per se, right? Or a catalyst day. But most days, resilience will lead the market. If resilience lags the market, it means people were selling the index before they were selling the stocks, which is the rarer event. But what you'll notice is that whenever the market does dip really hard like so to the bottom, and you find volume, which means you find buyers, and resilience is positive, then that's a buy signal. While you're still finding buyers and sellers in the redistribution zone, then inside of the redistribution zone, a positive resilience means half gap is supposed to be support to push the market to that side. And there's the mechanic of that right here. Market dipped this morning and I go, that's a buy signal because resilience was positive. It hit here and I saw a volume spike. All three of those things happen. That's the buy signal on the scalp, you futures traders out there. Again, markets rallying to here. It hits the top. There are certainly sellers. Resilience is positive, which means I'm looking for, at this point in time, this to be support, for that to be where the sellers are found. And then all of a sudden, market's trading long, and I'm like, man, I wish I would have got on that long. But all of a sudden, this happens, we follow there. There's a volume spike, which indicates there were buyers here, which is great. And resilience is positive at that moment in time, which means we are still going to look for sellers, which again will be found at the gap close. So at this moment in time, I can quickly say 392.7 to 393.8. I can get 10-point scalp in the S&P because res was greater than 0. And even though it was doing this little song and dance right here, there's that trade. And when it got there, anytime you touch the edges and there's still volume, you tell yourself, I can still scalp with resilience all day long. The minute you touch the edge and there's no more volume, or volume's in decline, you touch the middle, there's no more volume, then resilience is no more of a scalping tool inside of the zone. But the neat thing is that ever since about 10:13 in time, res is positive, which means at best, half gap is support. The first video tells you that. If markets are rational and resilience is greater than 0, it means half gap, this white line will be support. White matches white, clear as day. So now that we pushed outside the redistribution zone, part 2 is that if resilience is positive and you're outside the zone, it wants to stay outside the zone. So your stop loss on a breakout is right here, and that's it. I drew them manually, how I got these edges. So does this make sense? When you're inside the zone, half gap pivots to the boundaries of the zone when resilience is positive. As long as you see volume at the boundaries, then resilience scalping is active. Once you lose volume, then there's no more sellers here. The market needs to raise price. Market makers raise price to find sellers, and now you're outside of the zone. Resilience takes on a second effect outside of the zone, which shows there are stocks still in that mode of filling their gaps, which means the S&P is still likely to price higher until that's no longer happening. And when that's no longer happening, resilience will go negative, which means SPY will likely come back into the zone and not know what it's going to do anymore. But I know that when you're outside the redistribution zone, and you bought this breakout because you said, ooh, there's no volume here, and resilience is positive, I'm longing there, and boom, I got the breakout. Where is my stop for the day? At the boundary of the zone. Right here. So with the resilience being positive, it tells me that the price will stay outside of the redistribution zone because it didn't find any sellers here. It needs to keep finding sellers at the next resistance you find. So I'm going to have two ways to look at a stop loss. Number one is I'll stop on the edge of the zone right here. Right? I'll put maybe, normally what I like to do is just put it slightly like halfway between half gap and the zone. So like a quarter of the way on my scalps on a small day like this. If there's only 1 point across it, then I'll give like 2 or 3 points stop below just to try to make sure I maintain that. But the second way I'll escape this trade is if resilience somehow suddenly goes negative. When you're outside of the redistribution zone and resilience goes negative, SPY will do nothing but love to jump back inside of it, and likely that's the reversal point of the day. So not only will this technique allow you to forecast moves in the SPY, forecast pivotability at half gap, open and close, but when you know when that pivot is no longer available, when there's no longer volume, then you're looking for your breakout, and then you can set your stop if resilience goes negative. I can get out of the way. So if the market is trading like this, resilience suddenly is in decline, I'm not scared. But if resilience goes negative, I don't care what this is doing. I'm getting out of the way because I know the next move is to go inside of here again. That's advanced resilience and how I use that to scalp futures, how to swing trade. I will get in and out of positions on that philosophy. I will adjust positions on that philosophy. But this is how I use resilience actively in the daytime to do trades. Any questions? That's a good video. I'm going to keep that. Just go back and watch the video. It talks about it right now. So right now, look, there's a little bit of dip into the zone, but res is positive. So let's watch it, right? There's clearly no buyers. There's no sellers here. There's no volume spike. But we also hit a resistance already. So the trade normally goes to next resistance. And that would have been where I would escape the trade. I wouldn't have held for a hedge pressure break. So we have to actually pair this up with liquidity map as a second thing. So bear short up, which is what the S&P was doing. Bear short up likes to press to hedge pressure and be resistance, right? So if I identified that trade and I go, ooh, it's going to break out of the zone and break out, then 393.3 to 395. It's 1.7 to 1/2. So it's a 3.5 to 1 trade. How awesome was that, right? Yeah, it's recorded. So I'm going to trade to my next resistance on the scalp. Normally, inside of the redistribution zone, you assume your next resistance is here or here. And all day long, I can scalp from here to there or there to there or there to there or whatever I want. If the distance is big, I'll take that scalp. If the distance is only, 5 points, I don't really take that scalp, right? So, but imagine it's like 3 points distance or 2 points distance. There's a lot of room to play, or even just, scalping a couple micros just to stay busy, also good. But what if I get into that trade here and I go, oh, there's no volume. Yes, it's going to break out. Immediately my brain goes, okay, what's the next target? Well, there's a hedge pressure here. There's a gap fill here, but no longer is there sellers. Where's the next target? Boom, hedge pressure. Or other targets from that predicting price target video, i.e. gap fills from previous days, yellow lines, red lines, etc. So pairing it with liquidity map, right now, res is still positive, but we no longer have this effect where volume is increasing. So we no longer have a gauge of liquidity inside of here. It's a little scary at this point. So now the market is just selling on a new mechanic, and the dealers are practically redistributed already. And so this redistribution zone is likely no longer going to have an effect. And right now, res is peaking positive. So it doesn't have any, I would say from this point forward, there's no effect that I'm going to use other than right now, if I was long, I'd really be getting out of the way. And any green pop that comes out, I wouldn't be trusting it. Because we now tuck back in the zone. Now, again, it's not leading the market because people aren't buying the stocks before they're buying the index. Right now, people are actually just selling the index straight up faster than the stocks. And the stocks are now catching up. So inside of the zone, now we're back inside of the zone. I can still use resilience to tell myself it's going to likely pivot to the bottom of the zone, but I'm no longer looking for that as a scalpable day trade anymore. But if I was still in a swing, I would tell myself, okay, it's likely to go lower, but it's likely not going to find buyers there. You guys remember that? We've escaped that. So I'm not going to assume that I'm going to get my support there anymore. Yeah. We good, guys? That's today's lesson. If you like the stream, click like. If you like what we do, go to rocketstudio.com, check out the free trial. Resiliency can pop up immediately and check it out. It's free for 7 days. There's no credit card required. You guys can learn about this. You guys can test this out on your own. Smash that like button. Super hard. Love you, Matt. Itai, love you, boy. Let's go. Concession. I'm out. I'm about to drive a U-Haul across Texas up to Dallas. So that's going to be fun. Not really, but hey, wish me luck. Spy to 500 by Christmas, buy the dip. Oh, yeah, no, spy to 5,000 by Christmas. Adios. See you guys. Love y'all.